Most influential central banks in the world, the U.S. Fed and the Bank of England, chose not to raise interest rates last week, giving investors hope that the long campaign of rate hikes could now be over. But inflation in both countries and here in Canada remains well above target, suggesting that rate cuts may be a long way off. Higher for longer is the catchphrase for investors right now. And then there's the surging price of crude oil. It's up more than 30% since late September, taking gasoline prices with it. That will give upcoming inflation readings a boost and perhaps lead to even higher rates. For insight, let's go to our featured guest of the morning. He's John O'Connell, CEO of Davis Rea. Thank you for coming in.
Thanks for having me, Paul.
What should investors make of the surging price of oil and what it could mean to inflation and to the response of central banks?
Inflation is one component of the way we measure the price rises or declines. Crude oil prices are very volatile. People are worried about this right now. We've been talking about inflation for 2 years and how low they're going to go and how fast they're going to go. Higher energy prices are a tax on consumers and on business. And we've seen $90 oil before, not that long ago, really. So I don't think you can read too much in it over the longer haul. There is no shortage of crude oil in the world. It's being propped up at these levels by the Saudis, who are restricting output, trying to make money back from lower prices earlier this year. So I think it causes a problem for forecasters that get paid to make forecasts on these kinds of things, which are impossible to do, by the way, because you have people that are fixing prices. But I think it certainly is pause for, if people are having to spend more money on gasoline, maybe they're spending less money going out to movies, those kinds of things. So people who are less privileged, the lesser privileged people, parts of our society, are having to mind their pennies much more. It's also important to realize, if you look at the streets out there these days, a lot of people aren't driving as much as they used to.
Yeah.
A lot of people take public transportation. A lot of people can't afford cars. So, just focusing on one number and saying, oh my goodness, that's going to cause rates to stay longer for higher, I think is, being a little bit over dramatic and a little bit simplistic in their thinking.
What about the higher mortgage costs that many Canadians and U.S. citizens are bearing? One thing we hear fairly commonly now is the apprehension that, as you said, with respect to higher gasoline prices, consumers, if they're spending more on that, may have to spend less on something else. What about the hundreds of dollars that many Canadians are spending on additional dollars on their mortgage servicing costs, not being able to spend it on other consumer goods?
100%. In some respects, the central banks are a cause of inflation because one of the components of inflation is measuring housing costs, and housing costs include interest costs. And so, in many respects, the central bank is causing part of this problem. And in the most recent press conference near the end, I think one of the reporters questioned Jerome Powell, the chairman of the Federal Reserve Bank, how do you think by raising interest rates and causing people to pay more money, you're solving a problem? And he admitted that yes, this is hurting the most vulnerable people of our society, but they're also the people that are paying the highest prices for society. And this is where I think central bank policy, it's always been called a blunt instrument, but in many respects, we're raising interest rates is not making it easier for people to afford homes. Raising interest rates is not going to cause the farmer to grow more chickens. Raising interest rates is not going to make the Saudis pump more oil. So in many respects, this monetary phenomena that we're going through right now is probably fighting, in many cases, things which they cannot solve. They're not stupid people. They understand that. And they also understand that these costs are causing the economy to likely slow. How much is uncertain because employment remains good. People like auto workers are getting pay increases. Lots of people are getting pay increases. Core goods inflation has moved lower. We can't control food prices. Interest rates certainly don't control food prices. So I think that, we're likely at that point where rates have stopped rising. Hopefully we can stop talking about that fairly soon and get on to making strategists make calls on something else that's more germane, and investors can get back to thinking about what kind of businesses they want to own.
Okay, well, let's finish this segment with your view on broader markets. Where do they go now with higher for longer in the minds of investors?
First, I don't think higher for longer is all that helpful of a term. I think most people, including the Federal Reserve Board, thinks that rates by this time next year will be quite a bit lower. In fact, they could be quite a bit lower if we actually do decelerate quite quickly. And inflation, they've said, as inflation moderates, they're not likely to keep interest rates at these levels, because that would be increasing tightening when prices are falling. My sense is that there are incredibly good values in the stock market. Strategists keep saying things are overpriced. They keep harping on the Magnificent Seven. Well, that's because most other stocks have not done very well, and the Magnificent Seven are great and high priced because they're the best companies in the world. So why wouldn't you want to be investing in the best companies in the world, particularly if growth is going to slow? You want to look for companies that have consistent, long-term, secular themes. So I think lower prices are an opportunity for investors to put money to work. If you listen to the strategists, they'll say, oh, not yet, not yet, not yet. They've been saying that for 2 years, and it's cost people a lot of money. I think if you make good investment decisions, think about your retirement in the long term, it's always a good time to put your money to work, particularly when people are pessimistic and worried about things that are going to pass. A year from today, we're not going to be talking about higher for longer.